Welcome back to the channel, bringing you the latest news from around the world. What's something people don't know about the US economy? The US economy looks strong on paper, but beneath the surface, warning signs are flashing. Let's break down 7 key risks shaping our uncertain future. The US national debt has soared past $35 trillion, an almost unimaginable sum that continues to grow every second. This staggering figure isn't just a statistic. It represents a mounting challenge that affects every American, whether they realize it or not. Interest payments alone are set to surpass the entire defense budget, meaning more of our tax dollars are going just to pay off old debts, rather than funding essential services or national security. This debt burden is draining resources from infrastructure, education, healthcare, and other vital programs that support our daily lives and future prosperity. This debt isn't just a number, it's a weight that impacts our government's ability to invest in the nation's future. It limits our ability to respond to future crises, whether natural disasters, economic downturns, or unexpected emergencies. Every new spending bill adds to a cycle where borrowing begets more borrowing, making it harder to break free from this financial trap. When the next crisis hits, our options will be limited: either cut spending drastically, which could hurt millions, or risk inflation by printing more money, which drives up prices and erodes the value of every dollar we earn. The debt is no longer a tool for growth, it's become a master, dictating the terms of our economic future and limiting our freedom to choose. Our economy is being weighed down, making it harder to invest in innovation, jobs, and the next generation's dreams. We're borrowing from future generations, leaving them with fewer opportunities and a heavier burden to bear. And the bill is coming due sooner than we might think, threatening the financial security of families across the country. This is the foundational crack threatening the entire system, a warning sign we can no longer afford to ignore. American consumers are also drowning in debt, struggling to keep up with the mounting financial pressures of daily life. Credit card balances have now soared past $1.1 trillion, reaching historic highs and putting more strain on household budgets than ever before. Many families are forced to rely on high-interest debt just to cover the basics: groceries, rent, and utilities, as wages fail to keep pace with the relentless rise in living costs. Meanwhile, savings rates have plummeted to record lows, leaving millions of Americans just one unexpected expense or emergency away from financial disaster. New buy now, pay later services make it easier than ever to spend money you don't have, hiding the true extent of personal debt and making the financial system even more fragile. Strong retail sales numbers can be deceiving, often masking the reality that much of today's spending is fueled by debt, not by rising incomes or genuine financial security. The American consumer, the engine that drives our economy forward, is increasingly running on borrowed time with little room for error. This is not a sign of economic strength, but a warning of deep and growing vulnerability for millions of families. Inflation remains stubborn, especially for essentials like food, rent, and healthcare. The Federal Reserve's aggressive rate hikes have made borrowing more expensive for everyone. Small businesses are squeezed by higher costs and higher interest rates, stifling growth. The housing market is paralyzed, with high mortgage rates locking out buyers and sellers. Banks holding low-yield assets now face huge losses, adding hidden fragility to the system. The Fed is stuck: keep rates high and risk recession, or cut too soon and risk more inflation. The margin for error is razor thin. The economy is walking a tightrope. The 2023 banking crisis wasn't a one-off event. The risks that shook the financial system last year are still very much with us today, lurking beneath the surface. While the headlines may have faded, the underlying vulnerabilities remain unresolved, and the sector continues to face significant challenges. Many regional banks are still holding large amounts of assets that have lost value as interest rates have risen, creating hidden losses on their balance sheets. These losses aren't always obvious, but they can quickly become a problem if market conditions worsen or if banks are forced to sell these assets. If depositors start to lose confidence in their banks, these so-called paper losses could suddenly become real, and that could trigger a new wave of bank failures just like we saw last year. On top of that, commercial real estate is emerging as the next big risk. With high vacancies in office buildings and a growing number of loan defaults looming, the sector is under serious pressure. Regional banks are especially exposed to these commercial real estate loans, and a wave of defaults could destabilize not just individual banks, but the entire financial system. If another round of bank failures hits, it could spark a severe credit crunch, making it much harder for businesses and consumers to get loans. and potentially starving the broader economy of the lending it needs to grow. The tremors from last year were just a warning sign. The real test for the banking sector may still be ahead, and the consequences could ripple far beyond Wall Street. Homeownership, once the American dream, is now out of reach for many. High prices and mortgage rates have doubled monthly payments, locking out buyers. Existing homeowners with low rates won't sell, creating a severe inventory shortage. The market is frozen, few buyers, few sellers, and prices remain high. This stifles related economic activity and widens the wealth gap. More people are stuck renting, unable to build equity or move up. The housing market has become a wall, not a ladder. The unemployment rate looks low, but the quality of jobs is declining. Many new jobs are part-time or low-wage, while high-quality positions are disappearing. More people are working multiple jobs just to keep up. Real wages haven't kept pace with inflation, eroding purchasing power. Labor unrest is rising as workers demand better pay and conditions. The headline numbers hide a split labor market, one of insecurity and stagnation. A low unemployment rate doesn't mean a healthy workforce. The disconnect is fueling economic anxiety. The US dollar's dominance as the world's reserve currency is eroding. Countries like China and Russia are moving away from the dollar in global trade. This shift is accelerated by US sanctions and the rise of alternative payment systems. The dollar's share of global reserves is shrinking, slowly but steadily. Less demand for dollars means higher borrowing costs and more inflation at home. The US may soon have to live within its means after decades of easy credit. This global shift threatens the foundation of American economic power. The US economy isn't collapsing, but the risks are real and interconnected. High debt, inflation, fragile banks, and global shifts all raise the stakes. The goal isn't panic, but preparation. Reduce debt, build savings, and stay informed. The coming years will demand resilience and adaptability. What insights or updates would help you most? Let us know in the comments. Thanks for watching Universal Insight.